Hello everyone, welcome back to the channel. So in today's episode, I'll be delving into two different companies here. Netflix is the first company and I recently just added Intuit. Second one is Intuit. For this company, I'll be offering some of my thoughts as well as my analysis of the firm so far. So I'll be covering this one here. It says, when thinking about a firm, it is best to think in terms of first principles. So first principles meaning think in terms of the most fundamental aspects of the firm. So simple questions that you can ask yourself include, can the company defend its share? Is there intense competition? Can the company continue growing? What levers can the company pull? Is there sufficient room in the market to grow? And is it more of short-term growth via cost cutting, or is it long-term growth with the general industry itself? So in the case of Netflix, we'll try and examine the different cases here. Let's start from this first key question over here, which is whether or not Netflix is able to defend its market share and does it face intense competition. So in the streaming industry, you have many different companies in the space. You have Amazon Prime, you have Apple TV, Hulu, Disney+. There's a lot of competition and market competition is driving down pricing power. That's why you're not seeing a lot of price increases across the board. You're seeing more bundling deals. That's a fact. Competition is still intense, but defending market share is a lot more possible for Netflix in the coming years. So there's something called minimum efficient market scale, which I alluded to in my previous video on Netflix. So it refers to the minimum market share a company has to hold in order to achieve cost efficiencies, to achieve cost competitiveness. And there's this other metric as well, which is something called corporate demand share. So corporate demand share is the share of consumer viewing time across many different platforms. So in terms of these two metrics, Netflix currently has a 24% market share, which is greater than a 20% minimum efficient scale. So what that means is that Netflix has significant share, has enough share to optimize for cost. Second of all, the corporate demand after the Warner Brothers Discovery deal, if it passes through, will be around 26%. So what that means is that it is also above this 20% threshold. And what that means is that the company has enough content IP, enough legacy content IP to supply the demand as well. The question is whether or not Netflix has the ability to continually grow ahead. So when you're about a streaming company like Netflix, there are normally multiple levers for them to pull. They can pull levers in terms of pricing, in terms of subscriber growth numbers. They can try and generate alternative streams of revenue through their existing subscriber base, which is what Netflix is currently doing today with this ad division. So if you look at the ad numbers in just the recent quarter itself, ad revenue was around 2.5x compared to last year, which was in 2024, with ad revenue making up around 3.3% of total revenue, with forecasted values at around 6% in 2026. So ad margins are typically on the higher side. For example, Meta is currently having high 40s in terms of operating margin. So increased ad revenue growth for Netflix, we will see meaningful margin expansion, which will be a driver for earnings in the future. Second of all is that the company can also grow margins through decreased amortization expense as a percentage of total revenue. So think this way, Netflix is currently holding their content spend at a relatively constant rate over the last few years. They're trying to make it such that it is lower than the revenue growth itself. And when your revenue growth is growing faster than your content spend, what that also means is that the amortization is growing slower as compared to the revenue. And when amortization grows slower than the revenue, what happens is you have margin expansion. And in Netflix case, this is actually one of the theses that I've alluded to in one of my recent videos as well. So the lever that I talked about earlier as well is pricing growth. So in the case of Netflix, it is currently offering the highest value adjusted for utilization rates. So this UBS, it shows over here that Netflix is currently offering the best value based on consumption. So this also further substantiates the point that Netflix is extremely sticky, and it also backs the data for the high retention rates due to the high utilization rates, and it potentially also means that the company has the ability to increase prices because consumers are using it a lot more. So I think the third significant question that all Netflix investors should try and answer as well is whether or not there is sufficient room in the market to grow, and whether or not the growth is from short-term growth via cost cutting or long-term growth with the general industry itself. So when it comes to growth for a firm, you can think of it in two ways. The first way is through cost-cutting measures. So this is typically linked to short-term growth for the firm. It is not sustainable. In the long term, what drives growth for the company is dependent on the company's ability to grow in a market that is currently still not tapped yet, that is still not saturated yet. And second of all is the company's ability to defend its share in this existing industry. So in terms of the SVOD industry, it is still forecasted to be relatively strong over the next few years. Although we're seeing significant decline in terms of growth as compared to the COVID years in the past 5 years or so. So growth is forecasted to be at around 7%, most of it driven by this ad-driven portion. And second of all is that Netflix as a percentage of total TV time spent is still relatively low. And with linear TV continued decline, this is actually a tailwind for the entire streaming industry. So as you can see over here, linear TV has been experiencing declines over the past 3 to 4 years already. It's continually declined, all while streaming and Netflix has gone up. So with sufficient tailwind for streaming growth, the next question is whether or not Netflix is able to capture those economics, basically defend its share. With continued streaming growth and lower churn relative to competitors, I believe Netflix will be able to do so. So examining all these different factors, I'll try and cover why the stock is down based on this Q1 figures here. So it beat estimates in this Q1 report. So they beat on the top line, they beat on the bottom line as well. But the reason why the stock is down is due to their Q1 forecast, as well as them restricting their buybacks because they're trying to basically pull in all the cash for their Warner Brothers Discovery acquisition. So here that the Q1 guide is actually on the lower side because it is driven by greater content amortization of 2026. So what that also means is that all this content amortization will be reduced in the second half of 2026. And in my opinion, the markets are just being a bit impatient with this one. So the company is moving towards the mature phase where it starts optimizing for margins. I think for Netflix, its focus now is to reduce churn rather than optimizing for huge subscriber growth, because even when the company is experiencing minimum subscriber growth, with content spend kept relatively the same, significant margin expansion can still occur. Your cost of content per subscriber will start to decline, and this will allow Netflix with the ability to basically undercut competitors if they need to try and squeeze out all the other competitors. Or second of all is that competitors simply can't spend as much as Netflix because it is not profitable for them to do so. Next portion I'll be covering Intuit, and for Intuit they have 3 main business lines under them. First one is QuickBooks. So QuickBooks is sort of like a platform that allows your businesses to track the inflows as well as the outflows going from the business's bank. Second of all is TurboTax as well as Credit Karma. So TurboTax is a platform that allows consumers as well as businesses to file for taxes. Credit Karma is this financial marketplace that allows consumers to track their credit scores, to basically apply for credit and pay for stuff. Last one is MailChimp. MailChimp is this marketing platform that allows businesses to improve their marketing campaigns. As for Intuit, there are normally a few different modes associated with the business. So first of all is high switching costs due to data lockup. This is similar to Salesforce. This is similar to most of your software companies. Second of all is the high barriers due to the complexity of the tax code requiring usage of Intuit. Last of all is that accountants use TurboTax as sort of like their learning language. It is similar to Adobe where your learners will use Adobe as their main software. In the case of Intuit, accountants use TurboTax as a means towards tax filing. And when accountants use it, what happens is your businesses will naturally need to subscribe to it as well. If they're hiring an accountant to use the TurboTax to submit their taxes. So Intuit stock has been falling over the past year or so. So I'll be delving deeper into why the stock has fallen. So over here it says, so zooming into why the stock has been hit in recent times. My understanding of the problems are as follows. These are non-conclusive. Of course, there's a lot more problems, but this is what I've gathered from a day of looking into this stock. So it is AI risk as well as how Intuit is currently addressing it. So of course, all your software companies are facing sort of existential threat because of AI risk today. So that is something that Intuit is facing as well. So over here says that AI is a daily driver. So 46% of accountants use AI every day, and productivity is actually increasing with AI for 81% of accountants. So it is acknowledging more and more accountants which use QuickBooks as well as TurboTax using AI for accounting work to improve efficiencies. But the problem is whether or not those productivity gains are actually inside of Intuit rather than externally. So for example, OpenAI actually signed a deal with Intuit to have Intuit agents on the OpenAI platform. And if more accountants are actually using the Intuit agents outside of the existing platform, then this actually reduces the need for them to subscribe to their existing platform. But in Q1 this year, Intuit actually reported a QuickBooks Live surge of around 61%. So this suggests that for now, the productivity gains are still being monetized by Intuit and being externalized. So that's the first argument there. Second thing is this concern over here. So of course, I'll be giving you a bull as well as a bear thesis at the same time. So the opening bank ruling, this is a new ruling that the US government recently came out. So they said that it is a rule that technically went into effect for the largest banks in April of 2026. So it's coming up soon. It mandates banks to provide customers with 2 years of transaction for free using their APIs. So what Intuit is currently doing right now is they're accessing the data from the banks, they're paying the banks, and what Intuit does after that is that they keep the data inside the existing platform. So that's why you have data of more than 2 years on the Intuit platform. But currently, what customers can do is they can go directly to the bank instead of going through Intuit. So the argument here is that this reduces the switching cost for Intuit because data can be directly transported from the banks directly to the customers. The same source that Intuit accesses that information from. Counter this, of course, there is a caveat to this, which is that it decreases switching costs into Intuit, so it can come from other companies, other software companies moving towards Intuit, while also increasing integration into Credit Karma. With more access to consumer data, Credit Karma will be able to provide more data, and this increases the value proposition of Credit Karma. So there's sides to this as well. Last one is that the number of users are actually falling, the number of active users. So currently, Intuit's TurboTax is substituting number of users with growth in revenue. They charge more to customers, but the customer base is actually falling. So this is actually the recent report. They reported that there was around a 1%, 2% decrease in total TurboTax units. So total TurboTax users. So if you didn't know what Intuit is currently doing now in terms of the entire business model, they're sort of undergoing a transition as well. So what they're doing is they're trying to shift their lower tier customers towards higher tier by providing humanized solutions, like for example, actual human experts giving advice on the tax filings, on the financial plannings and so on. Intuit's current strategic move is to switch users from this do-it-yourself line towards higher tier subscriptions with a live expert. So this will drive their average revenue per user, but it hurts the top of the funnel, and we're seeing the effects today. So the question here lies in on whether or not they can retain those higher tier subscription for a sustained period of time at a longer duration and at a faster pace as compared to the loss of those lower tier subscription, those lower tier subscribers. Another concern as well, which is that your customers may be able to learn if they talk to the experts for a sustained period of time and then they swap back to the lower tier subscriptions when they feel a bit more confident. So to sum it up, overall my understanding of Intuit is that there are a lot of different uncertainties. You can't necessarily argue a bear or bull thesis. It is somewhere in the center. Of course, you can achieve substantial returns at this price. I believe Intuit is currently trading at one of its historical lowest valuations. But my overall analysis is this: Intuit's current uncertainties cannot be sufficiently rebutted with certainties and predictable outcomes for the next 5 to 10 years. And so, for this kind of companies, my normal approach to it will be to simply avoid it. I hope you guys have found this video useful, and I'll see you guys soon.